Welcome back to the Educated Homebuyer Live, where our goal is to help you buy right, borrow smart, and build wealth through real estate ownership and financing. Last week was an off week, came in on a Tuesday. I appreciate a lot of you guys showing up for that, but we missed our regular Wednesday meeting. Josh wasn't there. So, Josh, welcome back to the show this week, my friend.
Well, thanks for letting us come back.
Yeah, you got a nice little background there. Look at that,
You
people.
fancy, huh?
We're getting him. We're getting him adjusted to what this looks like, and he's done a good job. So let us know what you think about Josh's background there in the comments. But
It,
Josh, this week we still got rates up. The big news, I guess, or the anticipation, if you will, is tomorrow's CPI reading. So you and I have chatted a little bit off the record, and hell, over the last couple of months about CPI and inflation and all of this, and the idea or the chances are the reading could come in hot just because of where September numbers were last year. It's a year over year reading, so September is going to drop off. The new September is going to come on, and if the number is higher than where it was last year or a lot higher, then that reading is going to be something that we have to deal with, which is going to create volatility in the market, which in turn could lead to higher rates. So with that said, I'm going to kind of throw it your way and let's talk a little bit about rates and where the market is.
yeah, rates have actually held pretty well this week. I was having a little bit of trepidation in terms of what to expect because of what was on the docket for this week. So we had Columbus Day, markets closed on Monday. So we got a short week, but we got really important news, most all of it hitting today. And then tomorrow, like you said, the CPI is the big one. But we had the minutes from the last Fed meeting, which is going to give us insight into what the Federal Reserve members, the voting members, are thinking and talking about. There weren't really any surprises in the minutes. Markets kind of knew and have priced in what they think they're seeing. And then the other piece of it, we had a 10-year auction today. The 10-year auction was not great. Depending on who's grading, somewhere C to D grade on that 10-year auction, which makes sense considering that we have the CPI figure coming out tomorrow and the Fed minutes were coming out after the meeting. If we had actually had the auction at a different point in the day, it probably would have been a B to C grade auction. But all of that is just to say that I think the market has got to a point where they have a better handle on what's happening with CPI. They're not shocked by big numbers. And it is, we've talked about this on the show before, it is a fairly easy number to back your way into. We know what the number looks like last year that's going to fall off, and we have a pretty solid guesstimate of what's going to replace it. If we have a low number falling off and a high number replacing it, inflation as measured by CPI goes up. If we have a big number falling off and a smaller number replacing it, it goes down. So the expectation is 100% for us to have a hot reading tomorrow because we have a low reading from last year falling off. Right. So it would take a big surprise to the downside for this monthly reading, for the September monthly reading, for us to have the inflation rate go down. So it will be very interesting tomorrow to see what the markets do and how they react, because yesterday and today essentially flat, didn't really see any improvement or any worsening in the market. Tomorrow will be very interesting. I would have expected some front running, which it can go either way. If you're expecting a really hot CPI figure, front running would mean they would be selling ahead of that report hitting and rates would be getting worse. If you're expecting that to be a positive surprise, that inflation's under control and the Fed's going to change their mind, then the front running would be buying bonds ahead of it. We haven't seen really much of anything. So hopefully we don't get a big hot surprise tomorrow that would cause a sell-off. I don't think there's anything possible that makes rates get better tomorrow. I think we're likely to see more of the same. And if a surprise comes, it's going to be to the upside in terms of inflation.
And do you know what the actual reading is? I meant to look before we came on, forgot. Is it 8.3 or 8.1? And then the core, I forget what I don't remember it. I'll try to look it up here in just a minute. But
I want to say it's 8.1. And I saw in the loan officer forum today, someone was asking, it's like, why are the consensus estimates that it's going to drop to 7.6? Or why am I seeing consensus estimates it's going to drop to 7.6, but everyone's worried it's going to come in hot? I'm like, I don't know where you're seeing 7.6. Pretty much anyone who knows how the numbers are constructed, there's an 80% chance that we see a higher inflation read tomorrow. This should not be surprising to anyone. It is backwards looking. The most important thing, the Fed has been aggressively tightening in a shorter time frame than we have ever seen. So the risk there, just like the geniuses last year were telling us, No, there's no inflation. Inflation's transitory. We're going to keep stimulating even though we're seeing inflation reads. Now, this year they're saying, oh, we have to keep tightening. One of the quotes today was actually that the risks of not taking action exceed the risks of taking too
I
much
saw that.
action.
Yeah.
And that is exactly what they're doing. They're like, you know what? No one's going to say we didn't do our job. We're coming in hot and hard and stomping on the brake pedal with both feet. Well, the problem is the effects of that, it takes a period of time for it to be felt. It's not felt in a month, it's not felt in a quarter. So, really, the fourth quarter here, all of the numbers from last year in terms of CPI, the year-over-year comparisons get much easier. We had big numbers in the fourth quarter of last year. That's when we started seeing these hot inflation reads. Those will fall off. Inflation should also start moderating. If we get a surprise where we have a negative month where there's like a negative 0.2 reading and a 0.6 falls off, that's going to be a big change and a big adjustment there. And the Fed may start thinking, let's look at this and be
Yeah,
more data dependent.
yeah. Trying to predict what the Fed is thinking is obviously a job in of itself.
A fool's errand.
Yeah, exactly. I mean, they've already more or less come out and said in many ways that they're going to continue to do something or continue to this path until something breaks, which you and I have talked about and read and different. There's some smart people that we've talked about that think that they could stop what they're doing as early as November, and others saying that this is going to go through 2023. So it'll be interesting to see how it all plays out. But the reality is, the title of this video is "When Will the Market Stabilize?" The reality is it's not going to stabilize anytime until inflation gets under control and stays under control for some period of time. And the Fed, you know, not necessarily pulls back, but at least kind of dials back the aggressiveness of raising the Fed funds rate. You're probably going to have volatility in the market, and that's going to create additional issues. I mean, it's more of an issue, as we've discussed, when things, do more than what is actually expected in the market. And what I mean by that is if inflation is expected to come in at 8.1 and it comes in at 8.5, that's a problem, right? Because it means what the Fed is doing is not working. On the other side, or you could even use it in the same context where if the Fed, says they're going to hike the Fed funds rate, if they kind of give the consensus they're going to do it 0.75 of a point and they come out and they do it a percent or a 0.5% or whatever different from that, it's usually a bad sign in the market because, the market is expecting something. And when that doesn't happen, that creates volatility, which in turn creates, not destabilization, but, just chaos in the market. And that's what we're seeing. And that's why you're seeing home sales, decline primarily because of affordability, right? Rates are higher at 7%, more than double where they were at the beginning of the year. And that's putting a strain on affordability. And in turn, you got less people buying homes. With that said, there are still people buying homes. I put 2 properties in escrow in the last couple of weeks. And, I just put a listing on the market in the last couple of days, getting activity on it. So there are people out there looking. It is not, just a ghost town entirely, but there are less people. And Josh, while we're on that, I'm just going to talk about inventory real quick. So here locally, inventory, Orange County, 3619. So 3,619 properties, about where we've seen it within a couple of properties over the last, couple of weeks, not really moving up or down in a big way. Huntington Beach is actually up at 243 today. So last week we were under 220. So we added about 10% week over week. Now, what's interesting is it's not necessarily new properties coming to the market as much as it is homes no longer going off the market. So now some of those homes that, are sitting, not getting offers because interest rates are up and demand is down, those homes are sitting, and that's keeping that inventory from kind of moving the other direction. But I would guess that your peak, if you haven't seen it, is going to happen within the next probably 2 weeks, by the end of October for sure, at which point inventory should continue to decline through the rest of the year. Yeah.
Jeb, kind of go back to the conversation that you and I had earlier today. This is anecdotal. So anytime I tell you what I'm seeing in my experience, Jeb tells you what he's seeing in his experience, or you are experiencing at home, take it with a grain of salt. You're just seeing it through your lens of what's actually coming across your desk right now. It seems like the majority of folks that I am dealing with when I say kind of on the upper end, my clientele is not the $2, $3, $4 million purchaser. Our sweet spot is really, with after the appreciation of the last couple of years, about 800,000, let's say 700,000 to 1.2 million. Most of my buyers are in the million to million two range right now. So at the high end of that, we're seeing less of the lower end, and that buyer is, at least the ones that I'm dealing with right now, are more inclined to go after a well-maintained, upgraded property. And what we're seeing with those properties, the sellers still have pricing power. That doesn't mean the entire market. I don't even know, if we were to guess, Jeb, what would you say, what percentage of homes fall into that? I'd say less than 20% are the ones that are recently remodeled within the last 5 to 7 years, really well maintained, good curb appeal. The types of properties these people are going after, those sellers are having power. The dated homes, and definitely the ones that have a ton of deferred maintenance. Jeb, you and I asked you a couple of weeks ago, I'm like, what in the world does this seller think? They're asking $1,050,000 for a property that will not sell for $900,000. And you and I went back and forth on it. Yesterday, it comes back on the market. Apparently, someone put it under contract, which is mind-boggling. Comes back on the market, and you had mentioned, hey, there's another listing that an agent I know has in that neighborhood that's a nice house in that neighborhood, and they're in the nines. These people are asking $1,050,000. Well, today there's a price cut. I didn't tell you this afternoon. The price cut comes across, Jeb. It's $950,000. You're like, well, cool. You looked at the nice house in your neighborhood and said, we can't be priced more than that, but you're still delusionally thinking that you're going to get a price similar to that nice home. So what we're seeing, the middle tier stuff is moving, but it has to be priced right. And the low tier stuff, you're going to have to discount that stuff to move it.
Yeah, for sure. And I was talking to a lot of you guys saw the video where I talked to the Sacramento appraiser, who's also a data analyst, Ryan Lundquist. And today I talked to him. It was a question I meant to ask him while I was actually on camera, and it just, for whatever reason, we were talking, and that conversation, just so people know, it's not edited. It's just a conversation, right? So if there's a hiccup in there, it happens. And so some of the things that he'll say something and I'll be thinking, hey, I need to ask him this. And then it kind of goes a different way. And I forgot to ask him. So after the conversation, I said, because he's talking about the Sacramento market getting hit pretty hard. I mean, they're probably one of the hardest hit, one of the markets that's being the hardest hit. And I asked him after the conversation, I said, is it is it kind of, is it similar across all properties, or are you still seeing like nicer properties, turnkey properties, kind of like you said, the HGTV properties? Are they the ones that are still fetching a premium, while the homes that need work, inferior location, all of those are the ones getting hit? And he said, I wish you would have asked me that on camera, because that's exactly what it is. He goes, I can't figure out, I asked him, I said, is it because there's less people out there buying homes that have the cash available to do the actual work, and just don't have the money to buy that home? Or is it people just not wanting to go through the process, or like, what's the mindset behind it? And he said, honestly, I don't know, but he's like, people are looking at it like, I'm going to be in this house for a while. So if I'm going to be in this house for a while, I want a nice house. I don't want to have to deal with all the other crap that comes along with it. And I was like, that's a good way to think of it, because I mean, if you're going to be, ideally, if the market moves sideways, people are predicting 10% declines in markets, if you will. And if the market does decline, you're going to have to plan on being in that property for an extended period of time. And if that's the case, you better like the property you're in. Otherwise, you're going to have some additional issues to deal with. But on that same subject, Josh, I think it's interesting. I mentioned this in that video, but so in my neighborhood, and actually mentioned one of these the other day, in my neighborhood, there's a handful of listings now. There haven't been for an extended period of time, because once they would come on the market, they would go into escrow, and basically, the two properties on the market brought us back down to zero, and there's no inventory. So right now there's like 4 or 5 listings on the market in there. And almost all of them, in my opinion, are overpriced, and not overpriced in the sense that, hey, we're in a changing market and you just don't have any idea it's overpriced. Like, no, that thing's overpriced in the market that we were in a year ago. Like, what are you thinking? And one of these properties that just came on the market, as you guys have probably heard me say this before, and Josh knows this, but single level homes in my community fetch a premium because they're close to the beach. It's a nice neighborhood, nice amenities. And there's a lot of aging boomers in our area that are looking for single level homes. That's the next leg down, if you will, with the type of property that fits their needs. And there's one that just came on the market, yesterday or the day before, listed at 1.4. And now keep in mind, there's never been that model that sold at 1.4 in that community. In fact, I think maybe the highest selling there ever for that model's maybe 1.2. I don't know the number right off the top of my head, but in the 1.2s, maybe, never 1.4. So, and it needs full remodel. It needs to be gutted. So even if it were premium, it wouldn't be at that price. So I look at that and go, okay, so that's going to sell for significantly less. And so when it does, somebody's going to look at that and go, look, see, the market's declining because dropping. That property just went for $200,000 less. No, it went for $200,000 less because it sucked. And it was it needed everything and it was overpriced. And not every home fits that, but a lot of the homes out there do. It's like people are still trying to fetch this price on something that, even a year ago couldn't have gotten that price. So just take it with some context, take it with a grain of salt, know who you're, find a pro and let them provide some information, if you're out there looking. So Josh,
Jeb,
yes, sir.
Just sort of some follow-up information.
Yep.
Rafi here is viewer of the show.
Yep.
Been talking to him. Beautiful house. He sent over so some unique things about it. Highly upgraded, big lot, a great location in the Temecula area. I mean, not that there's bad ones, but he felt like it was really well located. And to kind of put it in context of what a bidding war is, I was just in a bidding war with a very well updated home, even in Temecula. So what does a bidding war look like in 2022 versus a bidding war in 2021? Last year, that home, it's listed for $730 and it looks like it's going to sell somewhere close to $740. So 10% or $10,000, what is that, 2-3%? 1.5% that we're looking at the overbid on that relative to the ask for a well updated, desirable, unique property. Last year that was 10%, some cases 20% over what the property was listed for, even if the list price looked reasonable. And this is what I'm seeing: 2 to 3 buyers engaged in offers on a really nice property, and high bidder or the cash buyer wins. I've got another client that's looking at 1.3 million plus or minus $50,000. The last 2, it's come down to 2 offers. They are incredibly well qualified. I've told both listing agents their money is as good as cash. You give me 17 days, we will close this loan. Sure enough, both of them go with that cash offer. But both Rafi and that buyer and your brother-in-law and sister-in-law.
Well, I'm actually going to talk about that here in just a second.
They're looking at really nice properties.
Yeah. So we'll answer this and then I'll say this and then we'll get some questions. But my brother and sister-in-law are looking at a property here locally in Orange County, and it's an open door listing. And they came out with a price. I forget the exact price, but let's just call it 1.3 million. My brother and sister-in-law said, we'll give you 1.1, right? Open door's falling apart. The world's falling apart. They want to put in a crazy offer well below the asking price and see what happens. Well, guess what? Open door reduces the price by, I don't know, like 10, 15. I mean, they came down in the price, but they stuck pretty close to their asking price. So they're still not giving away properties yet. But what is interesting is they are actually, the price that they came back with is actually less than they did pay for the property according to the tax record. Now, so in that case, open door would be taking somewhat of a shot in the pants, if you will, from where they paid. And it's because a lot of the times they overpaid for these properties, but I don't think that's a surprise to anyone out there watching. So if you're out there, just know what you're looking at. People aren't giving away properties yet, but with that said, around Earth, I don't know if he's serious or not, but says the housing market is crashing violently. I'm scared. Tell me something so I don't panic sell my house. Like, why? I hear this and I'm like, panic sell? Like, why does anybody panic sell? Do you have to sell?
Sell and do what?
I mean, if you're looking to panic sell it, I'll buy it for 50 cents on the, like, that's the whole thing. I'm like, tell me where the deals are, people. I want to buy real estate. Like, I'm looking to buy a property that's gone down 30 or 40%. Let's go. Like, let's make it happen. But Jeb, no, I mean, the reality is, unless you have to sell, who cares what the value of the property is? In my opinion, just continue to make your payment, live your life. And, at which point you need to know the value, then figure it out then. But it's not something you should be watching every day. Just like people that watch the news every day. I'm going to dig on you a little bit. Watch the news every day. You're probably going to go crazy because you're just listening to the worst of the worst information out there without really any context. A lot of it is just headline driven to get eyeballs, and then they move on to something else without really getting into detail on it. And the same thing for this.
When you're reading articles, it's easier with reading than it is with videos, just because it's hard to track exactly what they're doing. But even with videos, look at the headline and then read the actual data. Like my Google feed, because we look at this stuff all the time, my Google feed is full of
too much of this crap,
every bit of this. And you look and it's always this crazy headline, like, interesting, I want to see what data they have. And by like 3 paragraphs in, they're like, well, it's coming down a percent or two, and the headline is the world is falling.
I'll give you a really good one. Hold on.
Did you see the one a week or two ago? It was I think it was last weekend, Jeb, where it says home prices crashing the hardest they have since 2007.
It was down 2%.
1.5–2%, and it's an interesting measure of it. You and I looked at a couple of articles here the last couple of days. Miss Shedlock had a good one of his expectation is for a protracted period of subpar growth or small losses, but for a longer period of time. And that's what we've talked about. There's multiple ways where affordability can normalize. Affordability has to normalize. And what he failed to take into account, doesn't even consider as an option, is interest rates coming down. And I don't mean rates going back to 3%. I mean, instead of 6.875, 4.25, 4.75. There is a big difference there on high-priced homes. So really, we're going to get to a couple of you guys' questions, and a couple of you are asking on this. We don't have a crystal ball. We don't know when they're going to come down. But there are some very smart people on the deflation side of the equation that says that we will have deflation, and that will pull interest rates down. I don't know if they're going back where they were, but back down, that will increase the affordability from the levels that they're at right now.
No, good stuff. Yeah, I mean, the headline that I read today says home sales are going to nosedive in 2023, Fannie Mae says. Fannie Mae expects an average home price decline of 1.5%. Like, whoa, that's a nosedive, man. Get ready.
Yeah.
Protect yourself. Anyway, here we go. I digress. We move on. Logical thinker. We're going to start with you. Regular to the show. Appreciate you being here as always. Where do you think mortgage rates need to fall to remove the lock-in effect of sellers not selling their houses? If rates fall to that level, will we go back to waiving contingencies and bid above the asking price? So it's a really good question and one that's difficult to answer. I think if you saw rates go back down 5%-ish, you would see buyer demand pick up. Now, what that means is hard to say. I think it's more of those that got priced out because of affordability and those that are maybe sitting on the sidelines just waiting for something to happen, that gets those buyers back in the game. Now, does it go back to a waiving contingency? And I don't think so. Maybe on some properties, but I don't think as a general consensus that happens. Because I think if rates were to go back down there, even though it's higher than what a lot of sellers have locked in, I think some sellers that want to move for whatever reason, they want to, if they find the right property and, or if rates come back down, they're kind of sitting there. I think that kind of gives them the motivation they need to do something. But again, I don't know if 5% is low enough to make that happen. I think that only helps the ones that are truly like the people that are ready to go. It doesn't help those that, that are kind of iffy about the whole thing to start with. Josh, what are your thoughts on that question?
I think it's under 5% for sure. If we used a very conservative rate of saying most people are in somewhere 3.5%, it's probably closer to 3%, most homeowners. But if we say 3.5%, a 25% increase to that rate would put you about 4 3/8. So I think that number, and there's nothing magic about 25%, other than that's a pretty large increase in the rate of interest you're paying. Forget that it's 3.5% to 4.5%. It's a 1% increase. It's a 25% increase in terms of the interest that you're paying. And I think we need to get back to that range to get a lot of people off the fence. Would rates under 5% get some sellers off the fence? Absolutely. But at scale, I think we need rates somewhere in the 4 to 4.5% range. And I expect that to come. Would I bet my life on it? No, I would not. But if I'm betting, I'd say 2-to-1 odds that in the next 12 to 24 months, we have rates normalize into that, but somewhere between 4 and 5% with a 4% handle on that rate. And that will open a lot of things up. It will open up borrowing. There will be a lot of people happy to unlock their equity in their home with cash out refinancings. You're seeing a lot of home equity borrowing, which is suboptimal. Those rates are 6.5, 7.5, 8.5%. The HELOCs are adjustable and will continue going up with every Fed rate hike. So it looks attractive in terms of not giving up your 2.75 or your 3.1 interest rate, but it opens up a lot of activity and normalizes things. Nothing takes us back to 2020 or 2021. But if you remember, what were we saying here? This is not healthy. Double-digit home price increases, bidding wars on crappy properties in bad locations. That's not healthy. That's not good. The only person that's good for is someone that has a subpar property that they want to get off their hands for top dollar. It's great for that person. For everyone else in the chain, realtors and mortgage people included, that is not a positive. I don't need an insane market to make good money. It's helpful to have an average market. I consider I'm pretty well above average. So if we have an average market, I'm going to do well. It's where you have a bad market, you're only going to do okay. So this year has been very interesting because of the uncertainty. No one knows what comes next, and where we go, and it varies a lot. We talk here every week, Jeb. This is all local. Sacramento market is very different than what we're experiencing here in Orange County, and I'm sure that's not just a California thing. There's areas in Texas that are one way, and then you're in Nebraska and it's totally different. So it will be interesting. And you and I have spoken, Jeb, that we really want to see year over year figures, and all the way back to last spring, in February, March, April, the market was really hot because people saw rates going up and kind of jumped off the fence and got into the market. We're going to see a much clearer picture when we get into April, May, June of next year. We'll see where interest rates have settled out. We'll see what inflation looks like after this really hot read. Most people are expecting that the inflation reads will be down into the 4s, maybe into the mid 3s by that time, and normalizing towards 3% by the end of the year. We want to see what impact that has. So everyone wanting these clickbait headlines and to get views on their videos, that's fantastic. But to actually make wise decisions over a timeline, you have to sit back and watch and see how it unfolds. We have some very good ideas of what is likely to happen, but no one has a crystal ball of exactly what's going to happen.
No. And while we're talking about areas, some areas doing a little bit better than others and so on and so forth. Francisco says, sold my house in Florida, want to buy cash in North Carolina. Should I wait 3 to 6 months? ? So I was just in North Carolina. That's where I'm from. Spent about a week there, and I was really in all parts of the state. I was in Eastern North Carolina, then I was in Raleigh, then I was in Charlotte. And what's interesting is, Raleigh is still, in talking to friends that are there, that are in the business, and just in general, the market there is still pretty strong. People are still buying houses. Things are still moving, especially in desirable pockets. I mean, the job growth there, the migration there, there's still a lot of people wanting to be in that area. And so the market there is pretty stable. Charlotte, friends there are saying that, they're seeing a much softer market. Things are definitely, sitting longer, more price declines. But what's interesting is that, they said the same thing. The homes that are nice and in good areas are still selling quickly because they still have people migrating there from other states, still people looking to get out. I forget what the number was, but it was like 8, and it might be more or less than this number by it was more than 8, but it was, I don't know if it's 8 or 80. I think it's 8. It said 8 new people move to Charlotte every day or something along those lines. So it's like 8 people are moving there every single day. They need a place to stay, and a lot of these people are migrating from other states. So it's got a lot to depend on where you're looking to buy in the state. You say buy now or wait 3 to 6 months. What's the benefit of buying now versus waiting? I mean, it's a hard one. I think if you could find the right property now, then sure. If you're not finding the right property now, then you would wait, right? You're not making a decision buying something you don't need. Now, do I think home prices could be less in 3 months? Sure, I do think that, just because of seasonality and because there's some softening in the market. The reality is, I don't know what the market looks like in 3 or 6 months. So telling you that you should wait 3 to 6 months because prices are going to be lower, I don't know that to be 100% certain. I think there's a chance of it, but in 3 months, there might be less properties on the market because, people have taken them off during the holidays. Less people willing to deal with that. Maybe rates are higher when you go to buy it in 3 months, and now it's more expensive to buy that property. So there's a lot going on there. It's really, we talk about it all the time, buying when it's the right time for you in your life, and not talking to me and asking me that question, because at the end of the day, my opinion really shouldn't matter. You got to do when it's the right time for you. So. But Josh, I thought this, I meant to bring this up earlier. This is an article I sent you earlier. It was actually sent to me by the gentleman that I mentioned earlier in the video, Ryan Lundquist, the Sacramento appraiser, who I did the video with a couple weeks ago. And I thought this was, a good article because it provides some context as to what housing, existing home sales looks like. So, at the moment, existing home sales expected to finish, I don't know, just over 5 million sales. Look at 2021 relative to basically the average. Yeah, it's going to be less, but those two are really like outliers, if you will. Once you take those out, that historical average is actually going to drop probably closer to where we're going to end up this year. But sales are, obviously a big part of the data that people look at. If you don't have sales in the market, the market just kind of moves along sideways. And it's an interesting question to ask, because if sellers aren't going to put their homes on the market and buyers aren't willing to buy, then where does the market go? And that's where I kind of draw a blank. I have no idea. But again, historical average, basically saying 2021 is an outlier, not a benchmark. But I'll put this article in the description. You guys can go check it out if you're interested in looking at it. Was there anything else down there? Oh, yeah. So it shows existing home sales comparison, 2022 versus the historical average, 2022 versus 2021, and then U.S. existing home sales, kind of on a linear graph there.
And Jeb, roll back up to
Yep.
the first couple of charts there that you
Yep.
showed. I want to point something out. In these, like right there, it doesn't look like 2020 was all that hot. But remember, we had 90 days of well below trend activity in that year. So it wasn't just at trend and then picked up in the last 6 months of the year. We had kind of a normal first quarter, a horrific second quarter, and then a rocket ship. So there's really like 18 months of outlier at that really high level. So again, it's going to be super, super interesting to see how this plays out. The thing that I know is that in all markets that I've seen in the last 26 years, when I got into the business, we were coming out of a down market. People weren't excited about housing, didn't think it was ever going to appreciate the way it had in the past. Got into a very hot market in the bubble in 2007, 2008, saw a downturn when, again, people looked at it and go, oh, why would I own a house? No one wants to buy a house. Millennials are never going to buy. They're going to live at home forever. They want to travel the country. Back to a solid, normal market for 15, 16, 17, 18, 19, and then another insane market the last 2 years. Through all of those markets, people in the stages of their life, 65% of American households want to own their home. And that doesn't change. The decision may change. They may not be able to do it if rates are too high, home prices are too high, affordability is too low. So those things are all things that we monitor and watch. But absent that, other things being equal, 2 out of every 3 people want to own a home, and we don't have enough of those in the country right now. So over the next year or two, we're going to find out. So last 40-year downtrend in interest rates, is that what was real? Or is this blip here so far a blip? Is that an inflection point? Are we changing to a new regime where interest rates are at a much higher level than what we've been used to? And if so, asset prices will correct. But when you're looking at housing, there's not a recipe for a monster fast correction. It's more that super long, flat to slightly down trend, because people that are in their homes just say, I'll post up. I got a great rate and affordable payment.
Good stuff. Orange pulp. I've been looking at real estate for about 3 years in Philly, and this past week was the first I've seen large 10 to 15% plus price drops. Is this happening in other markets? Honestly, I don't know a lot of other markets. 10 to 15%, I can't say for sure. I mean, obviously some markets are seeing some price declines. But 10, 15%, like what are you like? Where is that number coming from? Is it coming off the list price that you're seeing 10 to 15%? Because year over year, you're not seeing 10 to 15%. And that's, that's what you have to look at, in my opinion, is where is that 10 to 15% coming from? I think price reductions are real, price drops are real, especially with sellers that have to do something. And there are a lot of markets out there that are experiencing price reductions, price drops, price corrections, whatever you want to look at it. And a lot of those markets are the ones that were, that had the craziest gangbuster appreciation. Sacramento was one of those markets that went up like crazy. Well, guess what? They're now starting to see the effects of a slowdown in the market. People are having to lower their price in order to get it sold. Vegas, inventory's up 143% year over year. Now that seems like a crazy number. Like we talked about it with Ryan on the video earlier today. He said his market inventory's up 135% or 139% year over year. He said, but you have to understand, we're still only at 2.2 months of supply. So you got to understand where the base is to understand, okay, yeah, you've appreciated a lot, but what does that actually mean? So to answer the question, I think some markets, the ones with the most appreciation, are probably the ones seeing the biggest price declines. But I haven't seen any year over year 15 to 10% declines in prices. I think most markets are still above where they were this time last year. The people that are most affected, quite frankly, are the people that bought probably the second quarter, third quarter of this year. Those are the people, because prices have moderated, decelerated, declined in some markets, and these people got a higher rate. So those people are are going to be the most affected, but they'll also
because
be, what's up?
because of the two pieces, Jeb. They
Yeah,
they bought at the peak and they didn't get the benefit of the ultra low rates.
right.
If you bought in January of this year and you locked in your rate in December or January, you paid a high price, but you got a pretty attractive payment. You're right. Anyone in May or June, if rates don't normalize and activity pick up, but Jeb, in relation to this question, this one, when I saw it pop up, the first thing I thought about is that property over in Catfish. They listed it for $1,050,000. I'm not saying you and I are geniuses, but we both looked at it and just chuckled, like, you're out of your gourd if you think that house is worth anywhere near $1,050,000. And
In any market.
even you are a little bit jaded to the market, going, that's $1,050,000. There's hardly, your exact response was, let's pull up everything in Huntington Beach under $1,000,000. There'll be like 5 houses, and there was like 5 houses. So you're like, it has to be worth more than that. You're like, no, it's not a great neighborhood. The house is destroyed, and it's $250,000 of work to make it nice. So where we're at right now, like if you looked, again, for you guys watching at home who don't have the MLS data, who don't have that insight and don't see these bigger trends, you could look and go, oh my God, that house dropped 10%, $1,050,000 to $950,000, and it still hasn't sold. And mind you, it's going to sell for under 900 when it does. Someone could look at that and say that's a 15, 20% price drop. No, the number that the seller put on it was insane to begin with. So you have to look at that in context. And right now, the thing that will help normalizing that, this is the first wave of sellers getting hit with the 2x4 in the face with the reality that you can't take an ugly house and put a top dollar price on it. And a realtor only has so much power. Like, Jeb, you may have the self-discipline to say, hey, I'm not going to take your listing at $1,050,000. I'm not going to put my name on that. A person that sells 2 or 3 or 4 houses in a year is going to say, well, it's not going to sell at that, but let me put my name on it, get the sign out. Some people will make some calls. Maybe I get another buyer. We'll get some price reductions. Eventually it will sell. But what you're going to see is, like the other agent who has a rational conversation with a rational seller and lists a nice home at $950,000. Once that comes on the market, that crazy seller who's only seeing prices going up in their neighborhood, they're going to get a little bit more reasonable when they talk to the next agent, because the agent can come in with data. Right now, we don't have a lot of data of anything other than flat to the last listing. What do you think about that, Jeb?
No, I'm with you. I mean, I think we're on the same page there. I mean, it's, yeah, yes, yes. I mean, not much I can add to that. I think we're, again, I mean, I agree. How's that?
Jeb, we have an incredibly important question that and I feel bad because I hadn't even thought about it. It tells you I'm self-absorbed and not thinking straight.
I saw that.
Where's
Yes.
Jennifer?
Is Jennifer now has another job or something going on. She can only be here like every other week. So she's not here every week. So,
It's just not
you
the
know,
same.
if you want to be a moderator, reach out to me.
If
We
you're
can make you
looking
a moderator,
if you're looking
you know?
for an unpaid job,
Yeah. If you're looking for an
let
unpaid
us know.
job to be here every week, we could use you. But here's a good question. This is something I often get asked, and I'm not making fun of Willing here, but it's something that I'm like, really? Like people actually think that they could do this? But let's say you buy a house and have a mortgage. A few years later, the market goes way down. If your loan to value is impacted, can your lender change the terms of your mortgage, add PMI, etc.? The easy answer is no. The lender cannot change the terms of that document. Can't add PMI. Once you have PMI removed, they can't go back and add it back on. I have seen it where the lender has messed up loan docs after they've been signed and sent and recorded and had to make a correction after the fact, but never because of the reasons that we're talking about here. Josh, anything you want to add on that?
Yeah, no. What you're talking about, Jeb, is the compliance agreement. So for any of you who are not buyers or are going to be buyers or borrowers at any point in the future, your loan documents contain a compliance agreement in there. And it says if there are any non-material errors in these loan documents that make the loan non-sellable, you will cooperate with the lender to fix that defect, or your loan can be called due. It's just saying you're going to cooperate. Can't change anything in those terms. If your name is spelled wrong on the note in deed, they can ask you to sign it. I had one. This has happened now twice in 26 years of doing this. A couple of weeks ago, we closed the loan and the lender lost the note. The lender has to have the original note with your real signature on it. And they didn't have it, so we sent it out to the buyer and they had to re-sign. And they're like, well, I'm now you have two notes. I'm not going to sign two notes. I said, well, what would it mean if we had two notes? Well, that's two debts. No, it is not. Here's the one you signed. Here's the one they're asking you to sign. We had a copy of it. It's non-material errors in the docs. If they put the wrong address, the wrong parcel number, any of that stuff. But in the context of this conversation here, what are things that could possibly be changed? Like you said, adding mortgage insurance at higher loan to values. When you're getting the loan, lenders will require impounds for taxes and insurance. They can't come back if you put 25% down and the home price drops 20% or the value drops 20%. Now you only have 5% equity. They can't require you to have impounds. Basically, things can improve in your favor in terms of getting rid of mortgage
Yeah, but they're not going to
insurance,
get
getting
worse.
rid of it. They cannot get worse for you. What I will say, and kind of a thing that I thought of when I saw this question, Jeb, is let's go back to 2009, 2010. At that time, not many lenders were happily cooperating with loan modifications and voluntarily modifying the terms of loans to keep people in their homes. And hindsight being 2020, they realized that taking a small loss and modifying a lot of people's loans would have kept them from taking monster losses by kicking people out on the streets. Right. I think if we saw a downturn of 10 plus percent, you will see lenders more aggressively modifying loans and taking little hits to their profits versus a cascade of foreclosures, which we don't have that recipe for it. But I also think lenders don't want to see that again and will be much more willing to work with modifications.
I agree with that as well. So you probably saw the little logo pop up in the right corner. You saw the little scroll on the bottom. Didn't mention this earlier, but many of you guys know we have a podcast outside of the show where we deep dive into topics. The last one we just covered this week is how to shop for a lender, how to shop for a rate. Take a listen to it. If you're in the market now, you're going to be in the market. It's good information to listen to about how to take advantage of that. And then the link at the bottom will get you in touch with a lender in your market anywhere across the country if you are looking. So take advantage of that as well. And lastly, if you're listening so far, been in about 45 minutes or so, if you'll hit that thumbs up, I would appreciate it. It helps more people see it. And that is the goal here. So, we're going to go. This is a Seasick Sammy. Seasick Sammy says, in all your great wisdom, what do you see the Bay Area housing market doing in the next 3 months? And then goes on later to say they weren't being facetious. It's a serious question. So I know Bay Area, what I've read is that it's been hit harder than many markets out there. It's also one that appreciated more than many markets out there. I think, you'll probably see continuing softening. A lot of it has to depend on rates, guys. I mean, that is really in my opinion, the number one factor in how this whole thing plays out. If rates stay where they are right now, you see a lot of what we see right now. If rates go higher, you see bigger price declines. If rates go lower, you see less of a price decline, more stabilization in the market. So a lot of it has to depend on where rates go. I personally didn't see rates getting this high. I think at some, I think again, I'm not even going to put a prediction out there just because I've been wrong so many times. But there's some very smart people, that think that we're reaching a point where the Fed is going to have to back off, and not just because of rates and what people out there are deeming a housing correction, but because of the impact the dollar is having on other countries like Japan and the UK. And this is setting up bigger issues with how strong the dollar's gotten, and it putting pressure on the global market as a whole. And they're going to get pressure from a lot of sides to kind of tame it. And whether that happens, I don't know. I didn't think the Fed had the balls, quite frankly. Yeah, I said it, to do what they've done, and they've done it. The question is, do they have it enough to continue to put their foot on the pedal?
It wasn't the World Economic Forum, but it was one of these economic UN type entities just a week ago, basically published an open letter to the US government saying, hey, you guys have to back off. And so far, the US government, AKA the Fed, has said, pound sand, we are responsible for our economy here, not
and that's
all of
and
the
they should be. That's
Yeah.
the smart thing that we are. We always help everyone. In this case, like, help ourselves. But at the same time, I think that pressure probably leads to bigger things.
Yeah.
So anyway, let's move along here. So, and if you guys have listened to the podcast, what do you think? I'd like to know. I haven't really asked. There's not really a comment forum on there. There's no place for you to comment and tell us, hey, dude, you guys suck, or this one sucked, or you're awesome, or that was fantastic, or cover this. So if you've listened to it, let us know in the comments here what you thought, and if there's something else you want us to cover, because that is helpful, because we're kind of to the point now where we've covered the entire housing market, like in every facet, between the YouTube channel, the live, and the Educated Homebuyer podcast. There's literally nothing on housing I don't think we've talked about. But we're interested in hearing what you want to hear so that we can make more content around that.
Jeb, you have in your videos gone down the rabbit hole of FHA and other loan programs. Not sure if we should do that with the podcast, because an FHA loan or a VA loan for a veteran, VA loans are a spectacularly interesting topic. For the 90+% of people that are not veterans, completely worthless topic. So let us know what you guys think, what you would like us to cover, what would be helpful. And some of the stuff, that's helpful for us is things change. Things change quarterly, things change annually, and we'll be able to revisit and revise and give updates on things. We had one show where we had a guest real estate expert from the Arizona market. Would you guys like to have realtors that are local to other areas?
We are definitely going to do that, and that is part of Jeb being proactive and scheduling in advance. Jeb flies by the seat of his pants, people. There's no schedule. There's nothing over here. I am whatever happens in the moment happens. But with that being said, it is on my calendar to book some of the stuff out in advance, so we have some of these, because we're going to talk to some people in some really hot markets, because I think that's what you guys need to hear. And yeah, we're going to do that. But Ethan says, why is your podcast not on YouTube? I would listen if the audio was on YouTube. It was on YouTube. I'm not sure what happened here. I don't know if I lost it, but
they kicked us off.
No, but here's the thing. It's not on YouTube because it's more work that I have to put on YouTube. And that's really the only reason. Like, could we hire somebody to do it? Sure, we could. Have we done it? We haven't. So if it's something we should do, then we probably should do it. So that's good feedback. We appreciate
Jeb,
it.
I will take on that responsibility. I know you already do enough with your stuff.
Podcast is great. Excited to share with family members who'll be buying in the near future. Appreciate you for listening there. I'm trying to be an educated homeowner. Good stuff. So yes, awesome. Good stuff. And with that, the shirts, the good stuff shirts are coming, guys. I'll have a picture next week for you guys to vote on what you want.
Jeb,
All
let
right.
me throw a shameless
Yep.
plug here. So Monica says, yes, the VA loan topic would be great to help my father-in-law. Jeb and I will cover it at some
Yep.
point. The shameless plug is every Tuesday night, 5 p.m. Pacific. I host Vetted VA Live. Vetted VA is a group of realtors and mortgage professionals all around the country dedicated to helping veterans get honest, accurate information and expert service when they come time to buy or sell a home or refinance. So just in YouTube, just search for Vetted VA, subscribe there. There's a lot of videos. They do a live market update in terms of interest rates with one of the market experts every Wednesday in the middle of the day, but lots of good information there for your father-in-law. And we will be bringing a lot of that information over to the podcast as well.
All right, good stuff. 2.0. Recently, I have been seeing Redfin and Realtor remove home price history. So when buyers are looking to buy, they're unable to see how much the home was sold for. Is this legal? So, excuse me. I haven't seen this or noticed this. Some states understand are non-disclosure states. Like, for example, Idaho. Idaho's a non-disclosure state. You can't really find what a house sold for, any real, solid information on it on most websites out there. Whereas California, disclosure state, you could pretty much find everything. So I don't know if sites are removing it or putting it in a different place. But I would think that most of these guys would have it up there. That's part of the value in the consumer using these websites is being able to get all of this information. And if they're not doing it, somebody is going to do it. So they're probably better off to just keep it out there. In fact, that they want more information out there on these websites than ever before. Like commissions are now listed on websites in some states for the buyer's agent. Like the more information for the consumer, the better. People feel that, the better information they feel like they're getting. So I'm not familiar with that though, just so we're clear. James says, what will happen first? Will home prices rise again due to inflation, or will interest rates drop dramatically? I think the only way home prices rise big time again, or not true. Home prices can go up, but what's going to happen is you're going to have stabilization in the market, and you're going to have some time. But at the same time, you got to have inflation come down and in turn have interest rates come down, because until inflation comes down, you're not going to see, in my opinion, rates really move in any significant manner, just because of what the pressure that the Fed's doing or putting out there, unless they completely break the market, at which point, if they do pull back, then it just adds a cascading effect longer down the road. So Josh, what are your thoughts on that?
Let's close the loop on some of the things that you said and also step back. So people, it's funny, in real estate investor YouTube, or at least real estate investor guru YouTube, a lot of things talking about, hey, it's a great time to buy when there's high inflation. Real estate's a great hedge against inflation. Is it? The last time we had appreciable inflation was in the early 80s. Interest rates went high, home values increased through that time. So people say interest rates don't matter. We had a giant tailwind at that time that most people don't take into account, in that from the early 70s to the late 80s, we went from most households being single income households to two income. Mom went to work through that time frame. And even if she didn't make as much as dad at that time, it was increasing household income. So we talk about affordability here. What is affordability? It's the percentage of a household income that goes to a mortgage payment at the current home prices. So if we have inflation is not going to take real estate prices higher if it crushes affordability. Inflation, as Jeb said, increases interest rates. So if interest rates are going up, there's three pieces to the equation on affordability. What does the house cost? What is the interest rate? What are incomes? So we've hit the wall in terms of, and I don't mean the literal wall, we are close to the wall in terms of appreciation that we could see based off of the people that are able to buy homes at higher and higher prices. If inflation itself, we know inflation will take interest rates higher, and that's the only one of those three factors that can change enough in the short term that would cause home prices to go up. But inflation itself can't take home prices higher because it would take rates higher, it would take affordability even lower, and you would have less potential buyers. So I don't think that's going to happen. We said earlier in the show, I will say again, I think in the next 12 to 24 months, we're going to have rates under 5%. How much under 5%, I don't know. That will help some, but it's not going to magically take things back to super high affordability levels where you can see rapid appreciation again.
There you go. Good stuff. Let's see. I saw another question here. I just wanted to kind of knock off. This one I don't understand. Let's just go with it. Tiffany says closing. Oh, it's not even a question. I'm closing on a home in Savannah, Georgia next week. I went ahead and bought, and I am just waiting for interest rates to drop. I got a 5.75 interest rate, and the seller dropped the price from 255 to 222. So, congrats to you on.
So.
Yeah, go ahead.
Tiffany has another piece to this question, and here's something really important.
Oh, there.
VA appraised the home at 231, so hopefully the house value does not drop under 222. Tiffany, the cool thing is we don't care. You care because that's your home equity. If that home drops to $100,000, the VA will still do an interest rate reduction refinance loan, and you can lower your interest rate. We talked about this a couple weeks ago. One of our not so welcome guests was talking about if home prices drop, it doesn't matter if rates drop, people will never be able to refinance. FHA and VA both have streamlined and interest rate reduction refinance loans where there's no appraisal required. So it's not even a part of the equation. They say FHA and VA say we are on the hook for this loan at 5.75. Of course, we'll be on the hook for the same loan size at 4.25. Right. So you're going to be fine. FHA buyers are going to be fine. And if we found ourselves in a market where prices dropped significantly and there were a lot of people locked into higher interest rates than where the market was at, the government in the form of Fannie Mae and Freddie Mac will do exactly what they did in 2008, 2009, 2010, and they'll come up with a home affordable refinance program that also takes the appraisal out of the question and just says, are we only rolling the person's loan down to a lower interest rate at the same loan amount so that we're not taking on additional risk? We're actually reducing the risk by giving the homeowner a lower payment. So you're going to be fine, Tiffany. And my belief is most anyone will be fine regardless of what happens going forward.
There you go. Willing says Invisalign or save for a home. I think Invisalign. You got to have good teeth. If your teeth suck, owning a home doesn't matter.
The problem with Invisalign is you got to wear that damn retainer to sleep for the rest of your life.
Yeah, but I mean,
depends on how.
At least you have here. Nice. If you're on the street, at least you have nice teeth when you go to ask for money.
It depends. If you have like B grade teeth, I'd say buy the house. If you've got like Austin Powers F grade teeth, then you probably go for the Invisalign.
Yeah. It's a difficult one, but yeah, to each his own in that one. Do you think prices will pull back by December, then go up some next summer like the last 2 years? I don't know. I think you will start to see more inventory come to the market, even, at the beginning of next year, right? I think we've talked about what I expect this year. And I think, kind of seasonality playing into it, rates being higher, less people putting their homes on the market. Inventory's pretty much peaked for most markets this year. If it hasn't, it's going to be really soon. But, that's going to continue to decline through the end of the year like it normally does. At least that's my guess. Where we end of the year probably with the lowest level of inventory that we've seen since inventory started to really rise. And then as the market turns in the spring, even if interest rates stay up, you're going to see more homes come to the market. I just think that's a natural progression of what happens that time of year. The question is, by how much? Hard to say. I don't know that I see home prices really going up from that point forward, unless we see something happen with rates. If rates go back lower, like we said, I think you could see a little bit of pickup in demand and in turn, maybe pick up in prices. But if rates stay here, go higher, that's going to have an opposite effect.
You guys are probably tired of the word affordability coming out of my mouth. But if affordability doesn't increase, and the only thing in the next 6 months that's going to increase affordability is lower rates. If affordability doesn't increase, Jeb is correct that there will be more homes coming on the market in the spring than there are now in the fall. And there's only one way when we have additional supply without additional demand that prices can go. I mean, flat would be our best case scenario in that. Do I think it's likely we have lower rates in the spring? Yeah, maybe not all the way like we're talking about in the fours, but right now people would be pretty stoked for a 5.5 interest rate, a 5.75 interest rate, and that would bring some more support to the market of people stepping in and wanting to buy and absorbing that additional inventory. That's kind of why Jeb and I keep saying next spring is going to be incredibly instructive as to what happens. Where are interest rates? How many sellers come to market? How many buyers can afford to step in? We have no lack of people that want to buy next spring. How many of them can comfortably afford to do it to the extent that they'll make the decision to become homeowners?
Good stuff. And one of the best questions tonight, why are 265 people viewing but only 69 likes? Come on, fam. Let's show these helpful guys some love. So would appreciate if you do that. That's awesome. And thanks for the comment there so that I could post it. It's helpful. This is a question that's worth posting, even though it's inaccurate. And that's not a dig on Angel. I don't know. With all the homes that sold at record highs this year and California property taxes being reassessed within the next year, mortgage payments may see huge increases. The nice thing about California is you don't really see the huge reassessments, right? The most property taxes can go up in the state of California is 2% per year. So you do the math, right? $1 million property, the most your property taxes are going up is $2,000, and most aren't even going to see that increase. I think my property taxes this year went up by like $300 or something year over. I mean, it was minimal. And so that is not going to happen in California. In other states could be a bigger problem, but even a lot of those states have some sort of homestead to keep it from happening. So,
and just even more context on those numbers, Jeb, I paid $580 for my house in 2003. 19 years later, it's worth somewhere north of $1.5 million, and it's assessed to right around $700,000 due to those 2% caps. If I sell it, then the state gets to get a bunch more property tax. But until then, no. And Jeb, let's talk about the elephant in the room here. I love commenting on people's profile pictures, but we have every cliche in the world rolled into one little thumbnail there. They've got the sunset at the beach, cute puppies. We're trying to get the ultimate views here on that thumbnail picture. They rolled every cliche into one picture.
Hey man, that's how you got to get the clicks, man. You bring the dogs into the picture, the significant other in the picture. I
got to get my dog down to the beach with my wife and take some pictures at sunset. I'm doing this all wrong. I just got me in the picture.
Dude, you send out cards with your dog on it.
Of course I do.
But the other part of this question was, with inflation, do you see this becoming an impact on foreclosures? Inflation, in my opinion, is not necessarily going to impact foreclosures. It will be in some regard because inflation will impact homeowners in other ways, making things more expensive. But what I know to be true is that people need housing and people will fight to keep housing. But with that being said, foreclosures come as a result of somebody owing more on the property than it's worth, not making payments, and being kicked out of the property, right? I mean, I guess you could owe less than the property's worth and not make payments and still get kicked out of the property. But most people are smarter and know that they could sell, at least take some equity and move on. So will foreclosures increase, I think, is the better question. The answer is yes. But will it increase enough to have an impact on market values? My opinion is no. I don't think so in any way. And foreclosures only really impact the market when they are the price of them selling is at a distress level compared to where other homes are selling, right? So a really good example is back in 2009 ish. I was selling properties for Fannie Mae, doing REOs, and at that time there was a huge amount of supply on the market, and so we would do, a BMA, a broker's market analysis, and we would tell them what it's worth, and we would price the home. And eventually the price that we ended up selling that property for, even listed for, was below other market comps. And those homes would get purchased a lot of times by investors looking to buy them, hold on to them, fix them, whatever. But what they started to realize towards the end of having a lot of these properties on the market, towards the end of 2012, when the market started picking back up, is if they just did a little bit of work on these properties, paint, carpets, a little TLC, they could actually sell them pretty close to market value and in turn get what the homes were actually worth. And so I think when people hear the word foreclosure, they immediately think I'm going to get a deal on a property. And in some cases, you might be able to do that. But once a foreclosure hits the market, especially now, if it's actually on the MLS as a listing, the deal is gone. because there's too many people, too many flippers, too many investors, too many home buyers wanting that property, and therefore it's the opportunities, out the window. Whereas if you can find somebody that's distressed, that has a foreclosure, that hasn't listed it, and is it, that's a better opportunity to try to get a deal versus the open market. So, Josh, let's say we've answered some of these questions here.
Let's throw
this one I didn't. Go ahead.
Let's throw this one out here.
Yeah, I didn't understand that one. That was the one I was about to.
So, would you buy with a VA home loan if you qualify for no property tax? So,
no property tax?
If you're VA eligible in certain states, Jeb, if you're a disabled veteran, some have different thresholds. You get a disability rating with the VA, anywhere from 10% to 100%.
Right.
Depending on the rating, some states will exempt you from property taxes. California gives you a discount. We have one of the lamest ones in terms of how it looks relative to other states. I believe Texas is one of them where you pay no property tax if you have a VA disability. So
Wow.
the VA home loan is the best home loan there is out there. It doesn't require a down payment. It doesn't have mortgage insurance. It has close to the best interest rates of all loans. So if you're eligible for a VA loan, especially if you have a disability, I said there's no mortgage insurance. I should have said there's no monthly mortgage insurance. What you do is you pay a VA funding fee that's generally financed onto your loan that can be as high as 3.6%.
But if you're disabled, if you're
disabled, you are exempt from that. So in this instance, if you're saying you qualify for no property tax, I'm assuming there's a disability, so there's no funding fee. So 1,000,000% yes, the VA loan is the greatest thing in the world. So the question really here is, should you buy a home? Like everything else here is a screaming yes. If you otherwise think you should be buying a home and you can go with a VA loan with no funding fee and be property tax exempt, absolutely. When you're doing a rent versus own comparison, you're going to have a very different analysis than someone coming in and buying with a conventional loan or an FHA loan. And I would be shocked, depending on where you're at. I mean, here in Southern California, that mortgage may still be more than what it would cost to rent, but most everywhere else in the country, it's going to be cheaper for you to own a home than it is to rent.
All right. Dina has been patient. Put a couple questions in here. We're going to answer. Says, what % down payment is wise to have saved before seriously hunting to buy a house, or just save as much as you can, even if it's not 20%? So here's what I would say. If you have a down payment now, and you're considering buying a house, have that conversation with a lender just to see where your payment is and what type of house you get for that payment, and see if it makes sense, or see if you're way off. What I can tell you is, having the 20% down payment's nice, right? Not having the mortgage insurance. But as Josh has mentioned many times on the show, if you have good credit, if there's two borrowers going on the loan, the mortgage insurance is probably a lot less than you think it is. And in turn, you can get into a property without having to save that 20% down payment. To each his own. I mean, if you have 20%, great. It's usually a lot more difficult for people to be able to save that amount of money, especially if you look at California home prices, like what it would take to save that versus getting into a home and being comfortable with the payment and moving on. Now, if you're stretching yourself and you just can't make it work without having a larger down payment, then the larger down payment is the answer. But the nice thing about, mortgages is you can actually leverage, the opportunity to be able to purchase that property and buy with a lot less down. But at the end of the day, it has to make sense. So to each his own, right? I mean, we have people that buy homes with 3.5% down, 3% down, and we have people that buy homes cash, right? Have no mortgage or put 50% down, and each does it their way, and they do it for different reasons. So I don't know that there's a right or wrong answer.
Jeb, think about how our answer to this question has changed in the couple of years that we've been doing the show. In late 2020, all throughout 2021, my answer was home prices are rapidly appreciating. They're going up way faster than you can save. Mm-hmm. As soon as you can qualify for a mortgage with 3% down, 5% down, 10% down, get into the house. The best example we have, I was not fortunate enough to help him with the purchase, but Freddie Luna, who was a regular watcher and still occasionally watches, he bought in mid 2020 with an FHA loan. Late 2020. In mid 2021, we refinanced him to a conventional loan, took away the mortgage insurance, and he had 25% equity in the home. If he had waited till he could save 20%, he still wouldn't own a home. And he's sitting on a ton of equity with a very low rate, low payment today. So that was then, this is now. Now, would I tell someone, hey, as soon as you scrape up 3%, jump in and buy a house? Probably not. You want to make sure you have reserves. You're very comfortable in your income. You have your debts under control. You have good credit so you can get the best terms available. And Dina, my guess is going to be that the way you're phrasing and asking this question, all those things fall into place. Like, let's say you have 16% saved. Would I wait till I have 20%? Absolutely not. Like Jeb said, talk to a lender, see what it looks like with 10% down, and keep that other 6% in your pocket, because we don't, like, think about this. What if home prices drop 20%? We've gone through it a million times here. I don't think in any world that's going to happen. But if it did, would you rather have that 6% still sitting in your bank account, or would you rather have put it down on your house and watch it evaporate? And you may be saying, well, I'm more upside down if I didn't put it in my house. At least you have the option and the access to the funds if it's in your bank account. People freak out and they think mortgage insurance is an awful, evil thing. The higher your credit score, especially with two borrowers on the loan, mortgage insurance is generally incredibly cheap when you get to the 10, 15% down levels. And you can occasionally look at a single premium, pay it up front. Million different options there. It's very important that you're talking to a mortgage advisor that understands all of those options and can show them to you.
Yeah, I mean, example, and this is a really vague, I mean, like just off the cuff example, but I did a video recently where purchasing a $500,000 home, putting 5% down, you know, what does that come out to? 475 or whatever the number is there that you're financing. You know, highest tier credit borrowers, say you have, you know, high 700 credit scores, 800 credit scores. There's two of you on the loan. I think the mortgage insurance on that was like $100. So it was relatively cheap. Comparatively speaking, that actually might've been a little bit less than $100. So, you know, just again, it's either put that additional money down or, you know, pay $100. I'd rather have the cash personally. But that's me. Josh, your setting changed. You ruined it. What's going on?
I still have the timer on.
See, you're no longer, dude, you're like a werewolf now. You just came out. Look, Willing's going to get upset. It's no longer dark in there.
Look how beautiful my settings are. Look what my wife found for me when she was reorganizing our garage, which she does about every 3 weeks. She found my old license plate in the closet there. So now we have more decorations for the office.
There you go. Good stuff. Dina has a second question. Do you know the age range of people looking for houses lately? I would say that I'm merely guessing. I don't know what the consensus is, but I would think that you've got to be probably that second tier buyer. So I would guess 30 to 60, you know, I mean, that's a really wide range, but I would think most of the buyers now have some money from the sale of another property, moving it into another property, and or towards the later part of their 20s and have an established job and being able to purchase. Just a guess. Hard to say.
So, Jeb, my answer would be 30 to 50. And then I can guarantee you, without even seeing it, it's a normal distribution. So your bell curve. So the bell curve is probably somewhere late 30s, early 40s is where the bulk of your buyers are. The median age of a first-time buyer is 33. So I don't do a ton of loans for people under 30. I don't do a ton of loans for people over 60. So it's that normal distribution where the majority of the people we're dealing with are between 35 and 50, with a few younger than that and a few older than that.
Good stuff. Here's an LO question. So Nick says, Nick's in a gaming chair back there. Says, I'm an LO in Houston, Texas, working for a broker. Is it a good strategy to reach out to new build communities to become a preferred lender in today's market? So is that even an option, Josh? Or do most of these builders have a preferred lender? I don't know the answer. I'm asking.
So for us here in Southern California, not the greatest option, because we've talked before, we don't have a lot of open land, so we don't have a lot of new construction. The new construction we do have is dominated by the big lenders who all do have their own mortgage companies. So you're just going to hit a dead end there. What you can do is go to the sales office if you have unique products, niche products, things that will help with fallout, and ask if you can get first look at the rejections from their mortgage company. And a year ago, that was a terrible idea, because they'd say, no, if my mortgage company says they don't qualify, I just go to the next buyer and let them sign the contract. So now that can be a good strategy. Houston, Texas, it's still a major market, probably a little more developable land, and there probably are some smaller regional, I don't know if they're local builders, but regional builders, and they may not have a mortgage company. But what you're going to want to do is approach them with something unique, hopefully a portfolio product, something that other lenders don't have access to. And you need to show them a track record of on-time closings. Far more than anything else, they don't care about rates, terms, fees. They want to know that when the house is ready to close on November 22nd, that you are in line and ready to close on November 22nd.
All right, good stuff. Sorry, just reading some questions here. Give me 1 second, Josh. You can pick some of them if you want. Here's a quick one. Can you buy a multifamily, consider it as a second home or a vacation home, Josh?
So in terms of the loans that are most common, FHA, VA, USDA are all primary residence only. So what would we be talking about? Fannie Mae and Freddie Mac do allow second homes. They both say explicitly in their guidelines it has to be not a single family residence, but one unit. So 2, 3, 4 units will not qualify. That doesn't mean that there's not a portfolio lender out there that might do it, a bank or a credit union, but most of them follow pretty closely to Fannie Freddie guidelines and don't step too far away from that.
Good stuff there. Chris says, are real estate professionals staying in the game? My girlfriend is an appraiser and business literally went to zero. So I'm sure there are agents dropping out. Listen, over the next 3 to 6 months, you're going to see a lot of it. A lot of agents will be out of the game. I think I mentioned this last week or maybe even the week before, but there's this like meme going around, if you will, like the CEO of Remax or somebody made this comment and now it's made its way across the internet because every real estate agent in the world has posted it, but it's worth mentioning. It said something like 91% of real estate agents have not sold in a market where interest rates were above 4% and days on the market were over like 45 days. It's interesting, right? So most of the real estate agents that are out there practicing at the moment haven't really had to be in a professional's market. And with that being said, a lot of those agents are probably newer agents. And so unless they've done well and established themselves, it's going to be difficult to keep things going in a slower market, right? Because here in Orange County, I think it's something like 20,000 agents or some crazy number here locally. And so you got to think, I mean, the amount of business is going to be cut probably by a third. And you've still got that many agents out there looking for that business. People are going to drop out, but I don't know of any yet. But hey, it'd be interesting. Like we should do like a website where like we keep track of like the people that are done. Like, hey, this guy's done. Just
the implodometer for
realtors. I remember that. That was good.
Yeah,
the implodometer.
That guy sold that.
Were just falling apart. They had.
I know the guy that created it, Jeb. He sold it for like $1.5 million. I'm like,
did he really?
What value does this have after the market is done imploding? But he was a young guy too, like 30, 34 at the time.
I remember that.
$1.5 million in his pocket. But here's my take on this, Jeb. If you look, the last 2-3 years, licensing went through the roof. Everyone saw this hot market and says, I'm getting a license. Most of them never sold a home. And when it comes time to renew, what does it cost you to renew every year, Jeb? Yours probably a little more because you're a broker, but what's a salesperson's license cost to renew? About $350, $400?
Oh, I pay like $1,200 a year. Oh, you mean just to renew the license?
Just to renew your license.
I think it's like $350 every 4 years.
Okay, so
every 4
no, when it comes down to it, is these people, when it comes to renewal, and it was all a great idea to get licensed. Right. When people will actually let their licenses go is when it comes time to renewal, and they have to pay for it. Right now, you won't see you will see the numbers decrease because a lot of people will be coming up for renewal and go, shit, I haven't sold a house in the last 2 years. Why am I going to pay hundreds of dollars for this unless I see something changing? But a lot of people, they might sell here. It's crazy. School teachers, policemen, firemen, a lot of them have their licenses. Yep. So they have other people around the firehouse, at the police station. School teachers have their summers off. And if they sell 1 or 2 houses, make $10, $12, $30,000 in commissions, do you care about $300 or $400 in licensing every year? It's not a huge cost, but if you're not doing any business, we see it every time. When volume decreases, people leave the business. When volume increases, crazy people get their license imagining they're going to sell a home and they never do.
But on top of that, like every year, it costs me about $1,200 just to be licensed with the board locally, to be classified as a realtor, all of that. So that's going to be coming up in January. My guess is that's when people go, oh, I don't think I'm going to do this.
Okay.
And the same for mortgage professionals, but we're
Yeah,
going to move on.
100%. Jeb, I got a good one after this.
Okay. Can you buy a house and just retain the seller's original terms of the loan, including the original interest rate? The answer is yes on certain types of loans. VA is one of them. FHA is another one of them. They both have assumable mortgages. It's a lot more in depth than we're going to get into right now. But there are options out there for it, but it's not as easy as it sounds.
Let me do the turbo speed version of it.
Yep.
As Jeb said, FHA and VA explicitly allow it. Most adjustable rate mortgages, because they adjust to the market terms, the lender will allow it, but not by rule. Fixed rate mortgages will all post 1982 or 83 will have a due on sale clause. So if the home is sold, that loan can be called due. It doesn't say that it will be called due. You can buy it subject to the existing financing, but if the lender at any point wants to call that thing due, you have to pay it off. So it's a big risk on your part. The piece of why a lot of assumptions are not being done and most people don't do subject to purchases is after the last 2-3 years, people sitting on a ton of equity. You would have to go in. I have, as an example, I have a client wanting to buy a property from a family member that just passed, from the estate of a family member that just passed in Idaho. And she would need to, they just bought 3 years ago and it's gone up $160,000. The underlying loan is amazing and it's VA and it's assumable and that person has passed. So no one cares about tying up that person's VA eligibility. So by all means, they would let her do it. She doesn't have $160,000 to put down to make the estate whole for the equity. So it just doesn't happen a lot.
There you go. Good stuff. Now click on the one that you had there.
I want to ask a question here. I see this picture. That name's not Alan Rhodes. What is that name supposed to be?
Jay something, right?
Yeah. But he got hurt that I said I don't do a lot of loans for people under 30. I would love to do lots of loans for people under 30. Those under 30 don't often buy homes or not at the rates that older people do. So it's not a choice that we're not working with the younger set. It's just a fact that most of them don't buy.
Well, with that being said, what I will say is that the best dating adult site, Tinder-hot.xyz, is that's spam, as many of you guys know. So we're going to hide that user on the channel, I think. So we just hid their message. But with that said, you said that guy's name's different on, whatever. Hey, listen, I just got messages today on Instagram that, hey, this, somebody's impersonating your account, sending messages to people about crypto and all of that. So if you follow me on Instagram or any other account, I'm not going to message you about crypto. Just so you know. Just so you know. And if you see it, report it.
Let's stay on the topic of this. Now, I don't even know. I'm thrown off. I don't know if this is Alan, if this is Jay, if that picture is not even him or her. This could be just a whole bunch of stuff. But Jeb, there's a great question for you. When buying high price homes like in California, would it be cheaper to take the class, be an agent, get your license, figure out how to represent yourself, and do it yourself? Is that a good idea?
I mean, I don't think it's a good idea, but it's a self-serving question. So, it's one of those things. Here's the deal. If I were to sell my house today, I probably wouldn't sell it myself. I would give it to another agent. And the reason for that is, for one, liability. Secondly, just, kind of being out of the game and letting somebody else take care of it. But when buying a property, I mean, I think if you're a professional, you understand the disclosures, you understand what to look for, all of that stuff. Sure, give it a try if you think that that's the right move. But I think most people that have done that, in my opinion, it's a little bit more difficult going through that process. By the time you take the license, get the license, understand what you're supposed to do, you probably missed the opportunity to buy that house. You've probably already lost money by going through the process. So it's a self-serving question. I would tell you that you should use a professional, but hey, give it a try if you think that you're worthy of knowing the business. So
Jeb, we also have an explanation. He says it is Jay. He got doxxed by Antifa and had to change his name.
I get it. I hate when that happens.
And a follow-up to the thing where we're talking about subject to, My 99 pops up here with due on sale clause insurance. Mike, Google for me and find a company that actually offers it. I'm not being a turd. I'm saying this concept was brought up to me 6 or 8 months ago, and I said, that's awesome. I would love to do subject to deals with due on sale insurance, and I can't find any of them, including the big one. There's a guy out of Arizona, Pace Morby, that teaches subject to investing, and he claimed to have a company at one point in time, but the website's gone, all the contact info is gone. So Mike, if you find it, post it for us in the comments.
Good stuff. Jordan says, what are your thoughts on a recast of a mortgage? My wife and I owe $350 on a house valued at $670. We want to possibly put $100K and recast. We are at 3.875. So recasting is awesome. Basically, for anybody out there that doesn't understand it, basically what happens is when you recast your mortgage, you'll put the $100,000 down. And now instead of paying his mortgage based off of where he purchased the home, it'll be based off the $250,000 loan amount, which will change the monthly payments to go lower. But Josh, is that something that every lender does a recast, or is it a certain type of loan, or how does that work? And what are your thoughts on it?
I've never had a borrower try to do a recast, a large principal reduction and a recast, and been turned down. I'm sure it has happened. I mean, when we talk about subject to investing, I've never had anyone had a due on sale clause enforced, but I do know people who have had due on sale clauses enforced through a roundabout way. So I would say it probably has been happened, but 99.9% chance you're going to be able to recast. So the question is, you're giving up liquidity. You have $100,000 right now in an uncertain economy. We don't know what's happening with home values. It could be that, if you have $100,000 in the bank, you might run off to Vegas if you're not risk averse. And by plugging it into your house, you no longer can touch it. So there's a benefit in that. But what you are doing is locking yourself into the 3.875 less any tax benefits you get on that interest. So not knowing where you're located and what state and local tax deductions come into play, I can't say that you have any tax deduction. So it might be truly a 3.875% return. So the question becomes, over the next 5, 7, 10, 15 years, do you believe you can use that $100,000 to invest and get greater than a 3.875 return? And are you, can you be trusted with $100,000 to not do something crazy with it?
Yeah, some people just have the goal. They want to pay off their house for whatever reason, right? Yep. And so if that's the goal, then great. Other people want to use, just continue to make the monthly payment and use leverage and use that money to make other money. And so in that case, I would say you're probably better off using the money somewhere else, unless the goal is to pay it off, in which case, sure, recast it.
Jeb, I want to stick to follow-up questions here because Ethan is incredulous. You said you wouldn't sell your home yourself, even though you are a realtor. Did you really say that, Jeb?
I did. So I have sold properties that I've owned in over the years, right? I think I'm at the point now where I am at that I'd rather have somebody else do it, and it's primarily because of potential litigation and just that sort of thing. Just have somebody. People are going to be more honest with them if something wasn't right with showings and open houses and all of that, versus coming to me knowing I'm the owner. You get less of that. And for what it costs to sell a house, I mean, I'm okay paying somebody to do it. I can't say 100% if I would go that route. I think it depends on the market. In the market that we've been in the last couple of years, I would have probably used another agent to sell it, just because it was so hot. In a slowing market where there's no activity going on, maybe I would do it. But yeah, a lot of times agents don't sell their own properties, or they co-list it with someone else and let the other person, take on some of that responsibility for the reasons that I mentioned.
So yeah. Just so you guys know, I am also a licensed broker. And I would say for me, almost any of my rental properties, anything that was not my personal residence, I would list it myself, just because it is a big expense, just like Jay or whatever he's now going by had mentioned. But if I was to sell my own personal residence, because I live there, people are going to be calling and arranging showings. Like, I think it would be a very difficult negotiation to have, or it would unnecessarily complicate the negotiation on something that is your primary residence. Like, I am far less emotional about my rental properties than I am about my house. So Jeb will probably get that listing if we were ever to sell, but I'm going to die in that house. So I don't think Jeb ever gets the listing.
Yeah. I'm just hoping he just passes it along to me. I don't have to sell it. I'll just move in. Just move in the backyard. Caesar says, what are your thoughts on Kathy Wood with the idea that the Fed is making a big mistake on inflation. So last week I mentioned, Kathy Wood basically coming out, and she seems to think that the Fed will pivot sooner rather than later because of what they're doing. There's things that she says that I think are smart, and then other things she says that I'm like, I don't necessarily agree with, but she's very smart. Like intellectually, she's a very smart lady. Her fund has gotten murdered over, and somebody even made that comment. They're like, you're listening to Kathy Wood, her fund's down by however many percent. True. I mean, there's some truth to that. So I don't know. I mean, I personally think the Fed has taken a really aggressive approach. I think they're doing what's necessary to get inflation down, but I think we're to the point where they've really got to start considering other things because I think what they've done will impact inflation, maybe not immediately. And I think what they're waiting for is they're waiting to see the actual impacts on the inflation numbers come down significantly. And I think by the time they see that, they're probably gone too far, personally speaking. But I don't know, Josh, what are your thoughts?
There's no question they were ignorant in stimulating way far into a hot economy. Think about this. I say this every time this conversation comes. They were buying bonds in early 2022. That's insanity. That's insanity. We were in a very hot market. The real estate market was fueled by artificially low interest rates because of their buying, and they continued to buy, even though we're talking about fourth quarter of last year, we had hot inflation reads because it's transitory. Cool. What if you were right? It was transitory. What potential benefits were there in continuing to buy bonds into early 2022? There were none. So right now they've lost credibility. They don't really have any other choice but to look like the tough guy and be incredibly aggressive. They have already gone too far. So back to the question of, is Kathy Wood right? Kathy Wood is incredibly smart, probably smarter than Jeb and I put together. That doesn't make her God or infallible. She thinks we are heading towards deflation strongly. And if I were to sit here and weigh the odds, I know other folks long before Kathy Wood came to that saying that the future is deflationary for a million different reasons: demographics, technology, over indebted governments. So do I believe that? I do believe it to be true. She thinks it's happening real fast. Jeb, you and I looked at an article earlier this week. I don't even remember the gentleman's name, but it came through the service from John Malden, where this guy's saying the Fed is going to break something here before the end of the year. And when it breaks, they will reverse course. So right now, it's sort of like the tough guy who's going around threatening to beat everyone up, and then someone steps up and socks him in the face, and they go, "Ooh, I better act a little bit differently." And what they mean by that, if you've been watching, UK bonds have gone through the roof over the last month, and most of our bond volatility here and the highest level of rates that we have hit in the United States are due to the bond instability in the UK. Well, they stepped in and did some things to correct it about a week ago, and by early this week, it was right back to selling. And their yields have gone up at like the highest rate that a major economy has seen in a long time. So when we talk about breaking something, we're not saying necessarily break something in the United States, although they could. They might break something in the global economy that has big repercussions for the US, and they have to reverse course. So I think she's right. I don't know that she's right in being as aggressive about how quickly she thinks it's going to happen.
Good stuff. Rich 777 says, are adjustable rates a good idea in today's market? Good idea is relative. Adjustable rates come with risk. The risk of you being in that property or having that longer than the term of the fixed portion of that loan, and therefore rates being higher and it adjusting to a higher rate that maybe is one you can't afford, and not being in a position to refinance into another loan because home prices have moved sideways or down or whatever. So there's definitely risk involved. It's a good idea in the idea that if you believe interest rates will be lower, okay, let me start over. It's a good idea if you think that rates will be lower within the term that you have that fixed rate. So if you have a 5-year adjustable, if you think rates are going to go lower within that 5 years and you're going to be able to refinance and equity is not going to be a problem, then nothing wrong with an adjustable rate mortgage. Now, some of those things you can't predict, right? You're merely guessing as as to where the market's going to go, what's going to happen with home prices, what's going to happen with rates, and all of that. But it's an opportunity. It gets you into a property. Adjustable rates have a really bad rap. They've always been around. They just have a really bad rap because in 2006, 7, people had 2-year adjustable rates, and some of them had prepayment penalties. They couldn't do anything. And so they've gotten a bad rap because of that. But, in the current environment, they offer a lower interest rate, and in turn can end up getting you into a property where you otherwise wouldn't be able to.
Let me do the turbo version again, a little more detail of what you said.
Mm-hmm.
People think negative things about adjustable rates because of the last downturns. They caused it. They didn't cause it. They were a portion of it. And there were two specific types of arms. An option arm where you had a fake made up payment at a 1% interest rate, and your loan would actually be growing until it hit 110 or 115% of the loan.
You weren't
balance.
even paying the principal.
Weren't even paying the principal. Your loan was growing. It was like you at age 30 getting a reverse mortgage is what it was like. The other type were the subprime loans. They were all written as 228 or 327, meaning they were fixed for 2 or 3 years. They had incredibly high margins. So you don't see that when you have the teaser rate that you start with. In 24 to 36 months, you get to see it because they would have a 5% initial adjustment cap, and every one of them was maxing at that. So as soon as equity stopped increasing, what the play was, okay, in 2 years or 3 years, I refinance and get a new 228 or 327, or hopefully I'm not a subprime borrower anymore and I can get a normal conventional loan. For most people, it didn't play out that way. Adjustable rates that we're talking about today are primarily hybrid adjustable rates, fixed for 5 years, 7 years, 10 years. And 7 and 10 are far more common because on the 5-year, you don't get to qualify at the start rate. You're qualifying at a fully indexed rate or even higher, which makes them not attractive for qualifying for more homes. So what are we talking about? Loans that are fixed for 7 or 10 years. And you're still going into it with the same thought process that either I'm not going to be in this home 7 to 10 years down the line, or I'm not going to be in this loan 7 to 10 years down the line. So the same thought process that people were taking out 228s and 327s were, oh, I'll refi in the next 2 to 3 years, but you're giving yourself a much longer time horizon. And it's also important to remember or think 7 years from now, 10 years from now, how much are you going to be making? How much have you paid that loan down? How much is that home going to be worth? It's probably going to be worth more than it is today, regardless of what happens in the next 2 to 3 years. You're going to pay it down 50, 60, 70, $200,000, and you're going to be making 20, 25% more than you're making today. So they are a good option. They are not for everyone. I have this conversation all day, every day, and I'd say 60% of my borrowers are not comfortable with them. 40% of them look at that and they go, of course I'm doing that. Why wouldn't I take the savings?
There you go. Habib says, I am in Spring Hill, Florida. Flip mobile homes so far slowed down a little bit, but I am in a market where we get a lot of snowbirds, still selling houses, just taking a little bit longer. So similar here. I mean, houses are still selling, just taking a little bit longer. Let's see.
I want you to answer this one, Jeb.
Well, I want to put this out there. Dominic says, just wanted to thank you guys. Closed on my first house in Houston. July 31st of 2021, watching all y'all lives. Keep up the good work. So I appreciate it, Dominic. Appreciate you being here, even after the search is over and you're a homeowner. It means a lot. Appreciate the support. What was that?
We got a good one here. You're pretty hip on the HOA stuff, having been a board member. Can an HOA prevent an investor from buying a house and renting it out? If they do, how would they know it's listed for rent? A house is listed for rent if listed online.
Yeah, so an HOA can actually well, I'm not going to speak in absolutes. I believe an HOA can prevent an investor from buying a house and renting it out because what happens is there's a certain occupancy that an association needs to keep in order for it to be a lendable community, if you will, right? So you can't have a community that is 50% or 75% investors, 25% owners, because you can't get loans in there, right? There's something called an HOA. A condo cert that has to be filled out on these. Is it a condo cert or an HOA cert? HOA cert on these properties. And one of the questions is occupancy versus non-occupancy in the community. And when it reaches a certain threshold, you can't get financing, and that becomes a problem. So I have heard of HOAs not allowing people to purchase properties when they plan to make them investment properties, because it would change those numbers and in turn create issues where financing is a problem. The question is, how would they know? Yeah, they would see it online. They might find out, from a neighbor or whatever. But when you're buying that property, the lender, the type of loan is being disclosed. So they're probably going to find out that way. So if you're buying it as an investment property, then they're going to know. If you're buying it as an owner occupied property and then you turn it into an investment property, I don't know that there's a lot that they can do after the fact, but I can't say for sure.
Yeah, it is a complex situation, and Jeb, as good as an answer as you can give without looking at the specifics of any individual property. So
Yeah, it's been a long time since I've actually come across that. I mean, that was back in the lending days where I remember that coming up. Being on a board, like the HOA in my community cares more about like Airbnbs, like turning your house into an Airbnb. That's a problem. And how we find out about those is from the neighbors, from seeing it online, that sort of thing. And that's more of an issue. But that's completely different.
And just remember, when you are buying in a common interest development like a condominium, when you buy, you are supposed to be reading and approving of the CC&Rs, which are covenants, conditions, and restrictions. So that's the restriction part. They can restrict anything. They can say no pets in the park and in the development, and you're agreeing to it. You may say that's crazy, that's un-American. We all love and have pets. They can put anything they want in there, and you are agreeing to abide by those when you buy the property. If you don't like it, you can buy a different property.
There you go. Christian says, recently sold my investment home into a 1031 exchange. So some of you might not understand what that means is when you sell a rental property, you have an opportunity to 1031 it. It's a tax code, part of the IRS tax code, that you can move it into another rental property of like kind and not have to pay. It has to be more than the property you're selling, and obviously some other things going on there. But you can avoid paying the capital gains taxes on it. You can just continue to roll it. At which point you pass away, you leave it in a trust, and things are good. But in this question or comment saying, have mixed feelings about buying now. Should I buy now or pay the capital gains and purchase and wait for prices to fall? I mean, I wouldn't want to pay capital gains, but if the capital gains is only, a couple $1,000, then maybe it's something to consider. But if you're talking big numbers with regards to capital gains, I would rather own the investment property and not have to pay the capital gains on it. I mean, an investment, in my opinion, is less emotional. It's really about the numbers. So if you can find an investment property that works for you, where the numbers make sense, then I think you definitely buy the property. But if you're looking at stuff where it doesn't make sense at all, you can't get the return you want, and the capital gains aren't that much, then maybe you go the other route. Josh, what are your thoughts?
The important thing here, as we always say, numbers never lie. Make sure you're talking to your CPA and quantifying what it is. I don't care about paying capital gains. You might have a $500,000 capital gains bill. You might have a $5,000 capital gains bill. So I certainly don't mean to insult you, but most people don't understand basis. They don't understand additions to basis on things that you may have done to the property. So if you go through it with your CPA, they also don't understand the other direction. You may have been depreciating the property, and so your basis has decreased through the years on that property. So you need to know what your basis is. You need to know what tax bracket you're in. You need to know if you take that gain, what bracket is it going to throw you in, and what does that tax bill likely look like? You may say, I'm cool with that. The property that I bought in Orange last year, there's a possibility that we may sell it next year. Probably not. It's $600 positive cash flow every month, and it's locked into the 3.25% interest rate. But at the same time, it's worth more than I ever thought it would be, and I don't think it's going to appreciate significantly in the next 3 to 5 years. So there's other things I could do with that money. But before I make that decision, I have to sit down with my CPA and say, hey, if I take this chunk in 2023, what is it likely to cost me?
Good stuff. Good stuff. So we got that one answered. Let's go back to a couple of these. I'm going to answer this one just quickly. What tips do you have for figuring out the value of a house on the market? Is the Zillow estimate worth paying attention to? I think it's worth paying attention to, but don't give it. It's just a piece of the puzzle. We've talked about it before. Really easy to manipulate those values in a lot of different ways. just because of the way they pull data. Some areas it's probably a little bit better information than it is in other areas, just because of, if it's tract housing, like if you're in a community and all the houses are exactly the same, none of them back to a major street, all the lot sizes are about the same, they were all, upgraded about the same time, then the value's probably pretty decent as long as the comps they're using to get that number are in that community. Whereas if you're in an area where, there's houses that back to the street and different lot sizes, different bedroom, bathroom counts, some are upgraded, some are not, and a lot of stuff going on, or maybe you're in a rural area and there's a lot that goes into it, and those are less accurate values. A good example here is a house on the sand in California, in Huntington Beach. They don't factor in what those views are. They don't factor in that location truly, because the algorithm doesn't know how to do that. So the best way is to talk to an agent, quite frankly, and have an agent give you an idea of what a home is worth. But outside of that, there's not really an easy way to do it unless you have access to the MLS and you can understand comps and can pull comps, at which case, you'll have a little bit easier job. But, it's a piece of the puzzle, not the only piece. But I don't look at it at all. Like if I'm looking at personally, like the value of a house, I don't go to Zillow, but that's because I have other sources that I know to be true. Now, I might get my number after the fact to say, okay, this is what I think it's worth, and then go say, okay, well, Zillow is way off on this, or, oh, Zillow thinks that's where I think it is. So maybe in this case, Zillow's right. So,
and I would say as a realtor, I wouldn't look at it at all, because it really, it's too important to look at it. For us on the loan side, if you call up and say, hey, I want to refinance, and ask you how much your home is worth, that's my first data point. What do you think your home is worth? I'm going to look at Zillow. I'm going to look at Redfin. Then I'm going to go look at 2 proprietary databases that the public doesn't have access to. And I'm going to say, do they all jive with what the owner thinks the home is worth? Or do we have a big stratification? And sometimes there's $100,000 range between the highest and the lowest. And at that point, I know that I need to dig into the MLS or reach out to my appraisal management company and have them give me an opinion of value for the local area. So sometimes, I would say the majority of the time, they're pretty darn close, but a lot of the time, a significant portion of the time, they're off, and oftentimes by a lot.
all right, good. I'm just trying to go through some questions. Dancing Alone with Rental says, I don't like mortgage insurance. If you qualified for the loan, why then are you penalized and forced to buy the insurance? When and when again for the bank? Because because the bank sees anything less than 20% down as a risk to them, and a risk of potential default. And if you default on that loan, they want some coverage, so that they're not penalized. I mean, just like your car, you might be the best driver in the world and think, I'm never going to get in a wreck. Well, guess what? Your insurance company, or, not the insurance company, but your lender, whoever has your car loan, if you have a loan on it, says, I want to make sure you have insurance so that if something happens, I get paid. No different. I mean, it is different, but it's the same type of mentality.
But really, it is insurance. You are insuring the lender against loss in the event of your default. If you put 30% down and you default, lender is very unlikely to take a loss. So they said, cool, you qualify, and if we're wrong, no big deal. We'll get our money back. If you put 3% down, it costs 5 to 6% to sell the house. Depending on where you are in the country, it's 6 to 24 months to complete the foreclosure process, during which time you are not collecting any payments. Property taxes are not being paid. The home is probably not properly insured, so they're going to put forced place insurance on it, and they're hiring attorneys to get you out of that property. So not a problem. No one is ever going to force anyone to take out mortgage insurance. A reasonable person can look at it and say, hey, does it make sense to pay a small additional fee to not have to come up with 20% to mitigate the risk of the person lending me a large portion of the value of the home? Most people agree that it is. If you don't, cool. No one's ever going to put a gun to your head and say you have to take a loan with mortgage insurance.
There you go. Good stuff. Let's see here. I'm going to answer this one really quick. Zoni says, are we going back to 2019 prices? No. Josh Arslan Khan says, do you see interest going past 7.12% by the end of the year?
I don't. I understand. I don't. Could I see it happening?
Hold on. So
Absolutely.
this is the rate that Mortgage News Daily is showing. So is that
Yep.
an accurate reflection of where rates are today, Josh? And you're saying you don't think rates go any higher, or is that rate listed high and you don't think we're going any higher?
It's a little bit high. So I'm running numbers for people today at about 6.875. So
Okay.
I don't think they're quoting a high number. That's just where most retail lenders and big banks are. There's a strata of where rates are depending on what sources you're getting the money from. So for best qualified borrowers, we're at 675, 6.875 in there. So could rates go higher? Yes. We're in a range right now on the 10-year between 382 and 402. I don't think we're going to break that range. Tomorrow will be the big test of it. Tomorrow's probably the biggest test of it. If we don't go above
Bro.
4.02
Ooh.
tomorrow, I don't think we're going to break above that. Could it happen? It absolutely could happen. Do I think it's going to happen? I don't. So we'll see. The rest of the year is going to tell us where it plays out, because I think 30 days from now, I'd say post Thanksgiving, we will be on the far side of interest rates and see them start to inch their way down.
There we go. That's a prediction, people. Javi says, what is the ballpark closing cost for refinancing? What would be an optimal rate drop to refinance at? Considering concern would be refinancing too early in case rates drop further. So a lot going on there. Josh, do your best to answer it quickly.
The $24 million question for you, Javi, is where are you located? We're in California. California is a relatively low closing cost state. We would be, depending on whether we get an appraisal waiver, somewhere between $1,800 and $3,000. The answer of how much should you save? Simple rule of thumb. We haven't talked about this much because most people aren't refinancing right now. Refinance apps are down 89% year over year. But take $125,000, divide it by your loan amount, and that will tell you the interest rate savings you need. So as an example, you have a $500,000 loan, take 125, divide it by 500, tells you 1/4% before it makes sense if your closing costs are somewhere 3,000 or below. If the closing costs are higher, you might want to see a little bit more savings. And there are parts of the country where there are high closing costs, and it might be realistic that it's $3,500 to $5,000 in a high closing cost state like New York. But check with a lender. But that rule of thumb is going to be pretty good for you. 125,000 divided by your loan amount will tell you how much you need to save for it to make sense. And Jeb, Kathy followed up with another question. Why would anyone refinance at this point? Opening one up right now. Borrower didn't have great credit when she took out her loan, so she doesn't have the best interest rate, and it has mortgage insurance. So the new loan with mortgage insurance will have a slightly higher effective rate, but most importantly, she's putting $100,000 in her pocket because she wants to move and buy a new home in 6 to 12 months, and she's not confident that the value will be there in her property to the level that it is, so that she would get less of her money out for the next move up.
And Ariel's a regular viewer on here too, says, got 3 family members who bought homes after I bought last year. They missed the good interest rates and paid too much for their home. In my opinion, do you think they have a chance to refinance? So, Josh kind of just answered that. I mean, at some point,
And Jeb, it depends on when they buy it. It kind of goes back to that question. If they bought in the first quarter and they have a 3.5, a 3.75, a 4% rate, maybe not. If they bought in the middle of the summer and they're at 5.5, 5.75, yeah, they probably will have an opportunity to refinance.
There you go. Let's see here.
A lot of questions and a lot of good ones tonight.
As market crashes or cool down, rate is different for different cities. So basically, price declines are different in different cities. Where would I get more accurate data on how my city is doing, and when is a good time to buy here? Closer to accurate data source. So I don't really know. And I mean, there are data sources that you can purchase nationwide that have more accurate data on what's happening with different things. Altos Research is a good one, but these are paid data. It's not cheap to purchase it. So I would more just tell you, find a good agent that you trust, talk to them about the market, see what's going on there, and have those conversations. But I don't know of a website or anywhere you can go that just gives you the context with the data, right? Data is one thing, but being able to understand what that data actually means month over month, year over year, historically, is very, very important. And I think, that you got to find some source, whether it be someone that you trust, in order to help you with that. Josh, anything? No.
No, you
All
got
right.
that one. But here's a good one. You were talking about data and the quality of your data. Tricia says people say the Fed's going to keep high rates for a couple of years. No one, including the Fed, has any idea what they're going to do. In their own statements today, they'll tell you they are data dependent. So that tells you that as the data changes, their plan will change. They don't know what they're doing with interest rates. They can tell you at the next meeting, which is I think November 2nd, so less than a month away, that they plan to raise rates. I think we can count on that. We can take that to the bank. Right now, they plan to raise again at their final meeting of the year. I think that's likely. But like we said, any number of things can happen between now and then. And some really smart people think that they're going to break something sooner rather than later. And their plans will have to change based off of the data that they're presented with.
No, I agreed. So we're going to get a couple more questions here. But before we do that, I'd like to ask a favor. If you'll hit that thumbs up, if you have found any value so far, it would be much appreciated. It looks, something like this little guy right here. Little thumbs up there. Hit that thumbs up. Feel free. I'm also doing short videos, some short content on TikTok and YouTube. YouTube. I'm not doing it on YouTube yet. On Instagram,
mainly
if you guys are
dancing
interested
videos. Mainly
in
he
that stuff.
dances on TikTok.
Yeah, just dancing up a storm, man. But yeah, if you like shorter form content, follow me there. But yeah, and last thing, link at the bottom will get you connected with a real estate agent, lender anywhere in the country. And last thing, Educated Home Buyer Podcast. Check it out. It's on every platform out there, and we'll give you a lot of
Except for
info.
YouTube.
Except for YouTube. But YouTube's not a podcast platform, is it? I mean, people are using it for that. We're not. We got the videos. We've got the videos. We can put them out there. We haven't done it.
Someone said they wouldn't listen because we are not on YouTube.
I know that sucks. So a couple questions here. Kim says, does all condos and townhomes have an HOA? Again, I don't like speaking in absolutes. I would say the greater majority do. I think it would be harder to find one that doesn't have one than one that does. So yes, without saying 100%. Yes, most of them do. Josh, let's see. I saw a couple other ones here.
Here, let's follow up
Yep.
on that MI because it's been a popular
Yep.
one. Okay, so Ethan follows up with, okay, so then why don't banks automatically take off your PMI, especially if values are way up? They do automatically take off your MI. FHA doesn't, it's on there for the life of the loan, but conventional Fannie Mae and Freddie Mac, when your loan hits 75%, 78% of the original purchase price, it comes off. There's an alternative measure that when you hit the midpoint of your amortization, that it automatically comes off. And if you think the value has gone up after you've had that mortgage insurance for 2 years, you can follow their process for getting an appraisal at your cost and proving to them it has happened. They don't take it upon themselves to monitor values and call you when they think that it can be removed. They're waiting for you to notify them that you think you're due to property price appreciation, that you've amortized the loan quicker than expected, and the risk to them is minimal. Jeb, do you like that? I just went back to the lights out.
Just how you started, bro. It's full circle.
Yeah,
full circle. Trisha says, what should I do if my realtor doesn't support my lowball offers? Why should I pay list price at such high interest rates? So here's the thing. If your agent doesn't support your lowball offers, it's probably because they don't believe that your offers are realistic and they're wasting their time. That's the easy answer. You got to find an agent that will do it. I'm not one of those agents that'll write a bunch of lowball offers either. If it doesn't make sense, I have people, doing the same thing, and I think it's crazy. But yeah, to each his own. I would say try to find somebody that's willing to do it. Most good professional agents out there aren't going to waste a lot of time on making a bunch of lowball offers unless they actually believe there's value there.
If Trisha calls you, Jeb, and says, hey, I found a house listed for $500,000. I want to write a $350,000 offer. How much time is invested on your part to write up and present that offer?
It's all relative. By the time I have the conversations up, I'd say probably a good 30 minutes or so. Maybe more if I'm having conversations going back and forth with people and whatever. It's not a huge amount of time in the grand scheme of things, but it is if I do that multiple times, and I could use my time better spent somewhere else. That's really what it comes to. What's my time worth hourly? And the real thing is, if I don't really see it turning in anything, then it's a huge waste of time. And that's where there's no interest on my side to do that. And that's probably what you're working with over there.
And you can tell us better than I can, but I get a lot of times I get in the email chain because my agents will copy me when the offer is presented, and I see the info coming back. We had one that wasn't even necessarily a low ball offer. They had it listed for like 825. The clients offered 770. They got a counter back for 795, and it went nowhere. Like and the selling agent, the agent representing our buyer, pretty much knew that, but it was in the ballpark, and at least now they're in there in line in someone's head. But like, it really can be insulting when you come in spectacularly low. Like, if you as an agent, Jeb, if I tell you I would like to write a $350, $1,000 offer, and you know that house is $410,000, are you going to advise, hey, here's why I think this is the least someone would reasonably sell it for, or where would you go with that?
I just stopped giving my opinion. Like, I try to tell somebody what a house is worth, the best I can in this market, and then when they want to go way under that, I just like, okay, like, sure, let's give it a whirl. And I'll do that once or twice before I'm like, I'm not your guy. Like, if you want to continue to do that, then I'm not your guy. Doesn't mean it won't work eventually. I'm not going to be here when it does.
And don't misunderstand, Jeb is a negotiator, and Jeb will negotiate hard, but we need to be reasonable and be in the ballpark that there's a chance. No one wants to waste their time, effort, and energy on something that's never going to go anywhere. So if you believe that your agent knows the market well enough to make that decision, then you find another agent if they're not willing to write them. But if you believe in them enough to know that they know the market, they're probably right to tell you where is a reasonable low ball offer versus we're pissing in the wind low ball offer.
Yeah. And then Rick has a question here, says, why would anyone sell in this market? Would new homes go down or less new homes on the market? So why would anybody sell? If they had to sell, they're moving, death, dying, divorce, or death, divorce, debt. If there's a reason that they have to is the primary reason. Or if they're just looking to make a move because it's a life event and they need more space and need that property and need to sell in order to do it. Would new homes go down or less new homes on the market? I'm not sure I understand that part, Josh. But we're going to leave it there. How's that? Sorry, Rick, don't understand the second part of the question, but we've been on here 2 hours trying to answer your questions, give you some feedback. So if you found any value, hit that thumbs up, like us, rate us, review us if you're listening to us on a podcast platform out there. But Josh, any final words before we head out?
It's Wing Wednesday. Those are my final words.
Wing Wednesday, he says. It is Wing Wednesday, but our wing place closed down. So I know where you're going.
Yes, you do.
All right.